Hi, hello everyone. Thanks for joining today. Hope you're having a wonderful start of the year, this 2026. We're halfway through January with the new year, a lot of stuff going on. And so this is our first Thoughts on the Run. This is our monthly webinar podcast conversation in which we share with everyone some of the main topics that we are seeing in our investment committee. As you know, my firm, AZTLAN Equity Management, is a boutique investment management firm. We started specializing in small and mid caps. We have expanded into large caps, fixed income, crypto, and just investments broadly. Also, we started in public markets, listed equities, but now we have evolved. We also have private investments, principal investments, and from time to time we help some friends and long-time clients in M&A advisory. So we do a little bit of everything, but our main focus obviously is our liquid investments. As you know, we have the 4 strategies: AZTLAN International Small and Mid Cap Strategy, what we call core. It's the core strategy. Then we have Prime, which is our flagship. That's what we started with almost 10 years ago. Similar to core, but we incorporate a global view. So that includes the US, basically. Then we have large caps, global large caps. And finally, we have fixed income. And on the ETF space, as you know, we have 2 listed ETFs as of today: AZTLAN, Global Small and Mid Caps, and we have a thematic ETF, nearshoring, which is the relocalization of productive chains in North America. Mexico, Canada benefit, but obviously front and center is the US corporations, basically. So it's more of a reshoring, but we wanted to have this more broad view, and so we call it a nearshoring strategy. So we have those 2 ETFs, the 4 managed strategies. There are some new ETFs coming later this year. We'll talk about that in future conversations. But okay, so let's go into what we're seeing, what we're discussing in our investment committee, and I'm going to make reference to the usual reports that we publish every month. They're available for free on our website. You just need to go to our website, download the PDF. The information is there. You can also reach out, call us, give me a call, send me an email. Happy to share all these reports from our investment committee. So starting with the macro view, we have this report, which we call the AZTLAN Monthly Market View. We cover first some macro aspects: inflation, interest rates, obviously key drivers for financial markets. For the US, for Europe, Japan, the rest of the world, emerging markets as well. Then we look at valuations and expected returns. So the first thing we should say is the expected returns across the globe range between low single digits for some of the European equity markets, all the way up to 10, 12% expected returns for the US equity market. What is the primary driver here? What we're seeing is earnings growth. Earnings growth is the key driver. Yes, the market is expensive. There's been a lot of commentary and people saying that we're in a bubble, the artificial intelligence bubble. The reality of the matter is, if you look at return on equity, especially for US companies, if you look at earnings growth, we are on an uptrend trajectory. So that's what we mean when we say that fundamentals are strong. Corporate earnings are strong, and that is what is driving equity returns, and that is why the current valuations, which are high, are justifiable. It wouldn't be possible to have this kind of earnings growth, earnings momentum, return on equity levels, and capital efficiency with discounted valuation. So it just doesn't work that way. So what we're seeing in terms of valuations is aligned with the capital efficiency. As long as corporate earnings continue to grow, I think we should continue to see at least relatively positive, maybe bullish equity market environment. I'll give you some data points in terms of earnings growth. The 20-year average earnings growth for the U.S. equity part is 10% growth per year. Right now, what we're seeing is 15% earnings growth, and that's in aggregate for the average set of listed companies. That's a 50% increase or upgrade versus the historical average. Return on equity. The average return on equity, the capital efficiency for companies, has been right around also between 10 and 15%, depending on which country you're looking at, whether it's European, the Nordics, US, Canada, Japan. But the US over the last 10 years, over the last 20 years, has clearly decoupled from the rest of the world, and American corporations have just witnessed an amazing expansion in terms of return on equity. So from those levels of 10 to 15%, which the rest of the world remains in that range, the US is an uptrend, higher and trending higher, and it is right now right around 25%. That's 25% return on equity. If you can invest your capital at a 25% annual rate, the compounding effect allows you to double your money every 2.5, 3 years. So that is massive. You cannot possibly have low, cheap valuations when you have that kind of capital efficiency in markets. So that's what we're seeing, very bullish in terms of the US equity, despite valuations. The rest of the world is interesting. The discount to the US remains. So there's a catching up effect that could persist over the coming months. And then going into the market segments, what we're seeing is small and mid caps, regaining that momentum. What we're seeing in our quant model, our quant model allows us to look into the global equity market in 3 ways. One is regions. Basically, we have 3 regions: North America, the US and Canada. We're excluding Mexico because we're only looking at developed markets. Western Europe, developed Europe. So that is the European Union plus the UK and the Nordics. And developed Asia. Developed Asia is Japan, Australia, New Zealand. 3 regions. What we're seeing is there's a reversal. The model last year was favoring Europe at the expense of North America. We're seeing a reversal. We're seeing the model getting out of European equities on a relative basis and increasing the allocation to the US. Asia, developed Asia, more or less stable. That's one cut. The second cut is by size or by market cap segment, and we divide by large cap and small and mid. Our internal definition of small and mid is from 1 billion at the low end and all the way up to 15 billion. That's our small and mid cap range. And large cap is very broad, from mid-sized companies, 15 billion in market cap, and all the way up to the mega caps, the Max 7. And what we're seeing is also a shift whereas the model was favoring large caps all through 2025, 2024. This year, last quarter of last year, what we're seeing is the model showing a reversal, reducing allocations to the large caps, increasing allocations to the small and mid. So we think valuations which are attractive at a discount to large caps, and that continued earnings momentum effect that we're seeing should provide that impulse to the small and mid cap segment over the coming months, maybe over the coming year. And then lastly, the third cut is the sectorial allocations. And what we're seeing in the sectors is a very sharp increase in the materials allocation, or the allocation to the materials sector. So mining companies, gold, silver, but also iron ore, lithium, and other mining companies. So it's very interesting to see that very strong increase in model allocations away from the more growth, pro-growth sectors, and into what we consider to be more pro-cyclical and traditionally perceived as value sectors. So materials would be the large indication that we have from our model. And then just jumping into the AZTLAN quant model, connecting with the sectorial and regional allocations, we're also seeing a shift from growth to value. So that, I think, is also interesting. Value companies have lagged over the last couple of years, all through the rally after the pandemic and the interest rate and inflation situation that we had 3 years ago, basically. So a clear rotation out of growth and into value. So those are the key elements that we're seeing, both from a macro, top-down, expected returns point of view, what the model is suggesting from the allocations, regions, sectors, and market cap segments. And then lastly, the final thing that I want to cover today is gold. So gold has had a terrific rally over the last year and a half. I think it's something that is well understood. It's just a matter of the basing of what we thought were hard currencies, like the US dollar, primarily the US dollar. If you look at the dollar index, the dollar has lost roughly 15% of its value against a basket of its peers in terms of currencies, developed markets, the euro, the UK pound, Japanese yen, etc., the Nordic currencies. 15% devaluation over the last year, approximately. So just based off of that, what we could say is that the markets, equities, the rally that we've seen, at least 15% of that is attributable to the currency effect, to the US dollar, because everything is denominated in US dollars. So what we're seeing is a continuation of that effect in terms of the commodities in general, but gold, silver. There's tremendous uncertainties brought into the geopolitical space. What we're seeing in Davos this week, this resurgence of imperialistic policies from the great powers. All these things provide the perfect background or backdrop for gold and other commodities to continue to perform well. What we're seeing is the fundamentals are there, the demand is there, and the thing that I think was interesting in terms of our internal discussions, our investment committee, we had this question brought up whether it's better, more efficient in general to invest in the commodity, particularly nowadays when we have a number of ETFs, low cost, highly liquid ETFs that can provide and do provide direct access into the commodity, in this case gold, or the gold miners. And the analysis was very clear. The conclusion is it is way better to invest in the gold miners, and for that matter, the majors. So companies like Newmont, Kinross Gold, which are the large commodity players. If you go back, at least in the past, obviously, right? This is impossible to tell whether this will continue into the future, but at least over the last 10 years, you've been better off investing in gold miners rather than the gold itself. So I think that's interesting. We're taking that piece of analysis, that data, into our investment process and making the proper adjustments into our strategies. Definitely, we're having exposure to gold, probably to other commodities. The other interesting area is uranium. There are some interesting companies in the small and mid-cap space that we're looking at. And I think with what we're seeing in terms of factor rotation out of growth and into value, I think that's also guiding our research process as we look for new opportunities across developed markets in the small and mid-cap space, as well as in the large cap space. AI, tech will continue to be a very strong driver. The space industry, defense, all those industries are also super interesting. There are a number of interesting companies with very strong fundamentals that we're looking into. But overall, we'll continue to do what we've done over the last 10 years at AZTLAN, which is look at the fundamentals, company by company, case by case, so that we can identify the 10, 15, 20 best companies within each sector, whether it's large cap or small and mid, across the globe, so that we can invest our capital, our clients' capital, for the long term. That's what we're doing. The outlook is positive, but with a number of major risks on the horizon. So we're cognizant of that. We're aware of those risks, and we're building our portfolios accordingly. So that's it. Those are the key ideas that I wanted to share with you today. Our first thoughts on the run for 2026. We did a couple of these conversations last year in 2024 and in the past, but now I think what we want to do is to do this a monthly chat, monthly conversation. Go to our website, download the reports. All the information is there. And if you have any questions, comments, send me an email. Give me a call, and I'll be happy to follow up. Thank you very much, and see you next month. Cheers.